Welcome to the February 8th edition of Market Thoughts. I'm Dave with Lighthouse. A lot's happened this past week. We'll talk about it. A lot on the docket for next week. We'll talk about that too, try to conclude with what we think happens next. First, quick plug here for Birthday Beacon, 2:30 on Monday. 2:30 on Monday, we're going live. Birthday Beacon will be doing a Facebook Live. Big announcement, possibly life-changing announcement. So if you don't want your life to change, make sure you don't tune in. Otherwise, follow us on social, spend 5 minutes with us on our Facebook Live on Monday. All right, starting with weekly changes like we always do, here's what corn managed to do on the week. Up a couple cents, not the worst news ever, but in the context of what beans did, pretty underwhelming. Also, I think important to note, failed right at this 436 resistance that we were talking about. That stopped the market just below it on Thursday, stopped it outright on Friday. This is not a particularly good feeling to leave the week on, especially again when you think about what beans did. It looks like corn's going to struggle to mount any sort of rally, and the sharply lower close on Friday doesn't leave us with any warm and fuzzy feelings in the short term. All right, let's see if we can sneak soybean chart out of here. There we go. Delete that no longer applicable resistance line. Here's what beans did on the week. Pretty fun time, 51 cents even for weekly gain. Ended up closing well off Friday's highs. Here's how this looks on a daily chart. Chased all the way up to 1137 and 3/4 on Friday, getting back almost within range of the 1172 highs from back in November, and then closed well off it. We'll unpack this further. Obviously, one key driver in this, but what it means, what we think happens next. And then there's spring wheat. Oof, what did I do there? All right, back to the day session. This is a pretty apathetic chart, to say the least. Spent the whole week mired in this same trading range. 4 days of losses to start the week out, and going back to last Friday too, after chasing up to 580, leaving us with some optimism. Even the gains in soybeans and to some extent corn couldn't get things turned around, and you close right at 570. You've just spent months in this same trading range. So far, we've held up our 560-ish contract lows like we expected, but we haven't been able to get up to this 590 resistance. Much haven't even got to it, much less tested and get through it. So pretty uninspired look here on wheat. And when you fan out to this chart overall, this is still a commodity despite these mediocre prices that has not changed its long-term trend. You're still in a long-term downtrend, even though you've traded mostly sideways. So not a lot of good news on wheat. Enough for wheat for now. Let's unpack what happened this week. So you had two main stories. Normally, this could have been your story for the week. 45Z guidance, long sought. They didn't give us all the guidance on 45Z, and more on that in a second, but we did able to glean some things from this language that came out. And basically, this was the advanced low carbon renewable fuels tax credit that the industry has long sought guidance for, that paves the way for more renewable diesel, for more lower carbon score ethanol, all of those things that pave the way for more demand. If you look at just some big winners and losers in this, canola is a big winner in this. Soybean oil is a big winner. Corn potentially is a big winner. I think it's important to note this is from Siouxland Ethanol, very good follow, very sharp guys at that ethanol plant. On corn itself, you're still a long ways from an ethanol plant being able to actually pay for low carbon under the 45Z clean fuel production tax credit. These three things still have to happen yet. You have to publish the final version of the feedstock carbon intensity calculator. You have to have an update to the GREET model that incorporates that feedstock module, and the United States Department of Treasury must publish additional guidance on those 2 points. So you have some things that have to happen yet for corn, but it's unquestionably bullish for soybean oil, canola oil. You got rid of indirect land use change in this model, and you also eliminated the used cooking oil loophole. You could only use feedstocks that originate in Mexico, Canada, US. So that was very positive. So this is supportive. You've got the administration saying, let's try again on E15, bring us another bill. That's supportive. And you put those two together, you're starting to see how biofuels can change this whole demand picture as we're going forward. So these are good long-term structurally supportive news. Neither one of these is drastic change overnight. This potentially would have an immediate impact on the market. This is a story that broke in the middle of the day on Wednesday with the president sharing a post, a True Social post, about potentially another 8 million metric ton, 20 million ton total for China to purchase in this crop year of soybeans. This is the extent, to my knowledge, the extent of any public official statements on this from either administration. But if you take it at face value, it's hugely bullish. Your projected carryout on old crop soybeans is around 300 million bushel. 8 million metric ton itself would be almost 300 million bushel. Obviously, that if that plays out, it wouldn't be a one for one thing. There would be other offsets of demand and whatnot, but it's really bullish, the potential of this happening. I think also worth noting in here, both sides have said 25 million metric ton next season, or basically just back to normal trade flow for the upcoming year. So that's also in amongst this. That's not new, but that continues to be a supportive thing when you look at our long-term outlook for beans, what we shared in our next trade segment on the 27th. So okay, so this is what we get tweeted out. Soybeans immediately post a huge rally, which makes some sense. What happens next here? I think a couple things just to be wary of, and this will feed into our takeaways as far as what to do next. Soybean inventories in China are huge. These are soybean stocks at port. This is million metric ton. You have the largest. Not only are you almost 15% higher than your 5-year average, you're the highest you've ever been this time of year already for stocks at Chinese ports. You also have this dynamic. If I can find the chart here, 1 second. All right, found what I was looking for to underscore this point. This is the other dynamic as part of this whole situation. These lines are U.S. Gulf, U.S. P&W, FOB Santos, Brazil port, and Argentine FOB values on soybeans. If you just look at where you're at right now, your U.S. P&W soybeans are $50 a ton more expensive than FOB Santos, and you still have the 10% tariff that applies to U.S. beans. You're well over $1 more expensive today on U.S. beans than you are Brazilian beans, and not to mention you're in the middle of Brazilian harvest. And I share all this just to make the point, if this occurs, if they take 8 million metric ton, it won't be because economics say this makes sense. It'll be a political gesture. It'll be part of the overall posturing between the two countries to move forward in a better light. And that's tough to handicap. It's tough enough when just straight economics dictate some of these moves to know for sure what happens next, much less when you're at the whim of those things. And presumably that would be beans just like the first 12 million metric ton that the state grain agencies purchase and put into state reserves. That would play out over a long time frame. And also, just given this spread, and presuming another 8 million metric ton of sales drives this spread even more absurd, you almost certainly would see Brazilian beans working back into at least the southeastern U.S. much sooner than normal. It's not that uncommon that happens in late summer and whatnot. It would probably happen much sooner than normal given the gigantic Brazilian crop and so far a pretty fast harvest and whatnot. So the point being, if in fact Brazil does, or excuse me, if China does purchase another 8 million metric ton of U.S. beans, that's really bullish for old crop beans. That's more bullish than the 1137 high that we hit today, but it's going to be a very high stakes situation to try to trade and navigate. So that's kind of the takeaways on that. There's one other thing in the middle of all this. We have a WASDE report on Tuesday, and that could reshape stuff again, given that the January WASDE was so shocking to the market. This is what the trade's looking for. 2.27 billion bushel carryout, ironically, right on the nose with the January result. for U.S. corn ending stocks. Soybean ending stocks basically unchanged. Main takeaway in this report, trade's not looking for much of any changes from what they received in January. Normally this Feb report would be pretty tame, pretty mundane. We will have more of a thought on what we exactly think in our update Tuesday morning and our Tuesday morning email. But just to note, this is potentially also another thing that shuffles this deck going forward. All right, so what's our conclusions? What's our takeaways on all this? Let's just look at analytics quick for corn. So corn, we stopped at this 436 resistance. We got signal chased all the way up to 65 when doing that. Our market gauges are still pretty low, except price to stocks to use is getting up there. And what about our new classifier model on corn? Here's what Friday's running was. Only 38% of the time has corn traded higher on days similar to what Friday was over the next 20 days, average change in negative 7.5 cents. So our corn data is actually pretty neutral or pretty negative in the short term. I don't think, especially absent bean support, I don't think we're getting through that 436 resistance in the short term. Clearly for corn, for grain that needs to be sold in the short term, March basis, stuff moving yet this winter, that target is where marketing should be thought about. At the same time, when you look at these longer term stories, E15, 45Z, potentially more Chinese purchases for sure for the next year, Chinese corn rallying, empirical evidence that you are going to see some acres shift out of corn into beans, all of that are longer term. Our next trade segment from January 6th, the longer term potential for spring, summer corn to rally well beyond these levels, that still holds. So we look at corn right now, things that have to be done in the next couple months. This 436 resistance is probably our target now, but longer term, we would still expect much better prices. All right, then there's soybeans that I think worth noting, just as a quick aside for how our analytics work in general. This was the morning of that Truth Social post. This is what our takeaway was. We had analytics back to neutral, seasonal remains higher, 45Z, lingering Argentine dryness. In the interest of time, we glossed over all that today, but provide some support. Beans have a decent probability of rallying for a third stab at 1084 resistance. Obviously that and nothing would have predicted the tweet that came a couple hours later, but just the analytics saying, hey, it's more likely than not on Wednesday and the days prior to that, the 3 days prior to that, the beans are going to trade higher in the short term. And that proved a useful thing to know then. What are those same analytics telling us today? If we look at soybeans, you actually hit day one of a sell signal on Friday's close. So you're back to a sell signal and your market gauges are still relatively low, but you are getting to where you've got a 69, a 55 on price to stocks to use. You're back to analytics that are saying, oh, okay, it's probably more likely than not that this is a good time to sell soybeans, or it gets getting close enough. And you pair that with the outside risk of 8 million metric ton of additional purchases is really, really bullish. But it's only going to happen as a gesture of political will, and that political will changes pretty quickly without much advance notice. And if that doesn't happen, then beans are overvalued at today's prices. So I think this sorts itself into a couple things risk management wise pretty clearly. This is a spot on these old crop beans, if you're behind on hedging, just to be making sales. And even if you're not behind on hedging, to be thinking about option type structures to still provide some upside if those beans do sell. But if they don't, that you don't let this second stab at north of $11 get away from a guy. I think that's what these analytics are saying. Now is the time. Wednesday wasn't the time. Now is the time to start protecting that floor, at least on the rest of these old crop beans, as we move into a heightened risk period here, just sorting out what does happen next on those Chinese sales.